starting with yesterday's Consumer Price Index report, because the monthly figure was twice what was expected, and the year-over-year figure is moving up. What did you make of that report? What does it tell us about inflation?
I think we're seeing maybe a little bit of inflation pressure cropping up around the world. And in the United States, the CPI index, of course, tells us that we've had a strong month. And maybe the convergence to the Fed's longer run target is a little ahead of schedule relative to what many of us thought.
So is the PCE going to hit 2%? We're going to get that report in a couple of weeks. That's what the Fed really gauges, right? We know we've got the core CPI at 2.5 and the headline, excuse me, at 2.3 and the headline at 2.5. But now people are saying, oh, the PCE is going to hit that 2% mark, and now the Fed is going to be on the spot because that's a target.
Well, understand, this is not a precise, exacting landing of a helicopter on a point. And you don't claim victory just because you've had a month that is close to the target. This is a target for the longer run. I don't think it's ever going to be precisely 2%, but we're looking to be around 2% according to the PCE index. And I find it encouraging that we're seeing that movement in that direction. But it could be followed by months in which we're off target a little bit. So it's a little bit more of a longer-term judgment than it is a precise game of hitting a target.
Okay. In Alabama this week, where my Bloomberg News colleague Steve Matthews covers you so closely, you said there was no urgency and no compelling reason to move on the key rate, the March meeting, which is now just about a month away. Did the inflation report change your mind at all?
Certainly the inflation report, the retail sales report that we just saw tell me that the economy is on the path I expected or a little stronger. So that if I were participating in the meeting and if I were one of the policymakers in this particular decision, I would find myself sort of persuadable that we could have a rate increase. It would be consistent with the path that I think the economy's on. But I overall still feel that what I saw at the beginning of the year as the path for the economy is what we're experiencing. And I premised 2 rate moves on that outlook. I could probably go either way at this point based on what we've seen in recent data. I would caution everyone, however, not to overreact to 1 month's data.
Okay, a lot of people, seems to me, are reacting very strongly to Fed Chair Yellen's testimony over the past 2 days. She did say it would be unwise for the Fed to wait too long, although she had said that also recently. She did say the economy is growing. Some people found it the most bullish testimony, most dovish testimony that Yellen has given for some time. Did you hear it, read it that way?
I saw the news reports that kind of labeled it as hawkish. My reading of what she had to say was that it was measured and that it really didn't say a lot more than we have been saying, many of us have been saying, and that is that 2017 is likely to be a year in which we see some rate moves, some rate hikes. Whether that's 2 or 3 remains to be seen. And I think she kept all options open, and she kept the March meeting live, which is exactly what I think is the right posture at this moment.
Isn't every meeting live?
I beg your pardon?
Isn't every meeting live?
Every meeting should be live. They tend to have been meetings in which there are press conferences scheduled, and the meetings in which we've moved, and so that we've gotten into a situation where much of the world expects it to be a press conference meeting versus a non-press conference meeting. But yes, every meeting should be live.
Well, you anticipated my next question. You reminded me what I need to ask you next, because it's so interesting. Over the last couple of days, if you look on Bloomberg World Interest Rate Projections, our very famous WIRP page, as of yesterday, well, actually, as of today is Thursday, as of Wednesday, the odds of a May hike had surpassed 50%. As I was looking at it last night, they were up around 61%. I think they're still around that level. Can the Fed do an interest rate increase when there is no press conference afterwards for the Fed chair to explain what the Fed did and why?
Yes, we can do that. The Fed can do that. There is a mechanism in place, as you know, to call an ad hoc press conference on short notice if the FOMC is going to make a decision. So everything is possible. We have 8 meetings a year, and each of those meetings should be live. And particularly this year, I think you should have to assume that something could happen even in a non-scheduled press conference meeting.
Okay, Dennis Lockhart, March is live, and you could move in May. We've got that on the table. I want to ask you a bit about the labor market and wages, because there's so many different ways you can look at it. U3 unemployment is 4.8%, but if you look at U6, which is much broader, it's still above, 9%. So you've got a wider swath of people who can't find the jobs they want and need. You have average hourly earnings, which haven't really risen very much, and they've gotten kind of flat again. You could look at employment cost index. There's so many indicators that say maybe we've got so much focus on U3, low unemployment, when actually maybe it's the U6 telling us this labor market is not that tight, there's still slack in the economy, and there is no urgency for the Fed to go right away to hiking rates. How do you see it?
I think we're close to full employment. That isn't to say there isn't still some slack to be absorbed out there. I think the decline in U6 over time has been encouraging because there's a reasonable argument that we have simply a structural difference relative to historical reference points in the amount of part-time people or part-time jobs in the economy. Many of the people who want full-time have part-time, but that's more of a reality of the current environment. I think that waiting for a long period of time for further improvement in the labor market is probably not a good posture for the FOMC to take. We are close to our objective, and therefore a rate increase is justifiable based on employment conditions.
Is the Fed close to behind the curve on inflation?
Well, I don't think behind the curve on inflation. We're still looking at numbers that are below and reasonably below. That is 2.6, 2.7, depending on what exact inflation measure you want to look at. 1.6 or 1.7, excuse me, 1.6 or 1.7, below the target, and we're moving in the direction of the target. That's all desirable. I would begin to be worried about being behind the curve if we saw a real strong inflation picture that suggested that we're going to exceed target and be above target for a long period of time.
You know what struck me all of a sudden, Dennis, and actually I was thinking about coming and talking to you this morning. If wages aren't rising and prices are, far from having an inflationary impulse, that strikes me as something that could be contractionary. Because if I'm a worker and my paycheck doesn't grow and my bills do, I don't see how that helps the economy very much.
We've had a little bit of an up and down kind of situation with wage numbers. The previous month was very encouraging. We saw 0.6% increase month over month. Then it slowed down in the most recent job situation report. We have in Atlanta something called the Atlanta Wage Tracker. Methodologically, it's a little bit different than the employer cost index or the other measures. So from that, we see a little stronger picture, and that has been consistently coming in a little stronger. I think when you step back, you should say there is some tightening going on and some acceleration of wage growth going on overall, and that's a positive indicator for the labor markets.
Are you at all concerned as the Fed gets ready for 2-3 hikes, and actually Eric Rosengren from the Boston Fed said maybe the Fed has to go more quickly, maybe do more this year, about a strong dollar? A strong dollar has many ramifications. It has ramifications for our U.S. manufacturers who want to export. It has ramifications for emerging markets who will be pressured on their currency front at a time when some of these emerging market countries have some fragilities in their economies, to say the least. Is that a concern to you? How does the Fed handle that?
The strong dollar is an indicator, or let's say a factor that can provides some constraining effect on the economy when other things are going well. The reason the dollar is strong is because people view the United States as growing more rapidly than perhaps other parts of the world, or they see the economic situation in the United States as generally a little bit more positive, and the dollar, therefore, is a desirable currency to hold. The stronger dollar then is a sort of braking mechanism on that whole phenomenon. And we can see the dollar as a countermeasure in GDP growth, affecting exports particularly, but also as affecting interest rates through inflows into the dollar from global investors. So I view it as a kind of byproduct of what is overall a strong, relatively strong economic picture.
Are you worried about protectionism? You're an advocate of trade. You actually helped start the World Affairs Council in Atlanta. You've worked globally. You have a lot of experience. You've worked in Latin America. You've worked many places. So you have this international view. Protectionism, is it a threat? Is it something that you are concerned about?
Well, I don't want to wade into all the politics around some of the proposals out there. Let me just say that protectionism could be a downside scenario if it gets out of hand, and if we find ourselves in a kind of spiral of reciprocal action between countries or between parts of the world where they feel they're threatened and take action, and we end up really in a trade war of some kind. If it's something less than that, then tweaking of agreements may not have a big economic effect.
You had a very successful career as a banker. Again, you worked in many parts of the world. So Dodd-Frank, you don't just look at it from a policy view. You've actually worked at large banking institutions under attack. Republicans think it's holding back bank lending, hobbling the banks. Janet Yellen and others have defended that the capital requirement, the higher capital requirement, in particular, as creating a safer, sounder banking system. What do you see? Is there some legitimacy in the argument that maybe the regulatory hand on banks has just gotten a little heavy, and it wouldn't be bad in some ways to lighten it?
First, I see regulation as a pendulum. And understandably, after the financial crisis and the recession that came from the financial crisis, the pendulum swung very far. And so some swinging back of the pendulum probably is appropriate, given now that we've had 8 years of recovery and conditions have returned cyclically to a rather good place, very much similar to what we saw in 2007 or 2006. Having said that, I see a big distinction between the regulatory approach to systemically important institutions and to the risk of a systemic event, and those that affect smaller institutions, even regional banks of medium scale, and certainly community banks. And so I think you can differentiate between what ought to be done opposite these systemically important institutions and those that really cannot plausibly be viewed as a potential cause of a systemic event. So I'd like to see some differentiation in that as the pendulum swings back.
In terms of your time at the Fed, as I started at the outset saying, a really historic 10 years for the Federal Reserve. The Federal Reserve faced the worst financial crisis since the Great Recession. Unprecedented steps, 3 rounds of quantitative easing, 0 interest rate policy in place for many years. Fed being questioned, being criticized, in some cases even attacked. What about the changes at the Fed? Where does it leave the central bank as an institution? And what issues, problems, challenges do you see now as you get ready to step outside this decade-long role?
The events of the last 10 years have put central banking and the Federal Reserve much more front and center in the consciousness of the world. This has been an era in which central banks have been really the focus of attention so much in the financial world. partly because fiscal measures were constrained for various reasons and because the central banks were the main actors in responding to the crisis and the recession. I think it's appropriate now that the baton pass a little bit from central banks to the supply side, to the fiscal side, to be taking the actions that will further strengthen the economy. Many of those ideas are in the air now. We'll see how they, in detail, actually play out. But it turns out that the 10 years that I've been in this role, they are historic, and they have been the period of central banking. Just not because I'm leaving, but because I think we've come full cycle. It's appropriate now that more of the fiscal kinds of corrections to what ails us in the economy be made.
Well, you make me think of something, because retirement, you're retiring from this role at the Fed. I know you're going to be doing something next. Maybe you'll write a book. But what are your plans? What's next for Dennis Lockhart?
I'm looking at a variety of things, and in all likelihood, it'll be a portfolio of activities, no single things. I'd like to stay involved in the private sector in some way, and I'm looking at a couple of options there, board service as well as maybe even a business venture, and also keep some hand in public policy if I can. Well,
you're welcome here anytime. Quickly, one word of advice for anybody who's looking at the Fed, thinking about the Fed. What's your succinct one-sentence advice?
It's an outstanding institution run by people who are absolutely dedicated to the mission and objectives that Congress has given the Fed. And I would, never be critical of the intentions of people who are working there.